Welcome everybody to yet another webinar from Marcellus. This is for our flagship strategy, the Consistent Compounders portfolio. And as the title of the webinar suggests, we're going to cover one of the important aspects of investing, which is SIP, or dollar cost averaging, or more disciplined way of saving, as Rakshit will explain to you later in the call. We'll also obviously discuss some of the fundamentals of the companies in the Q&A section. I'm pretty sure a lot of you have those questions on mind, given what's happening in the economy, what sort of recovery are we seeing in our portfolio companies, and so on. So just to set the context, folks, we introduced the systematic investment plan for investing into CCP and KCP, Kings of Capital alike, about a month ago. I'll give you a little bit of a context in terms of why we did that. Now, the reality is that most of you, I'm pretty sure, almost all of you, would have periodic cash inflows, right? Whether you're a salaried professional or a businessman with dividends and profits, whatever it is, you have periodic cash inflows, and I'm sure your inflows are significantly higher than your expenses, adjusting for some lumpiness maybe here and there, and therefore you're left with savings on a periodic basis. And every time you're left with those savings, either they end up lying idle in a savings bank account, or some of you might be smart in implementing these, sweep accounts where they get swept into a fixed deposit. In either case, it's not like you're going to earn a significantly higher amount of return in fixed deposits, especially given where interest rates are. Whatever it is, these savings sort of end up getting suboptimally deployed. Now, if there is no change in your overall financial goal and financial plan, and therefore there is no change in your asset allocation or the product selection, you shouldn't be left with any period in between where these savings or cash flows are lying idle. In my view, suboptimal returns. If your situation hasn't changed, you should simply incrementally allocate this savings into the same sort of assets which are driven off your financial plan in the first place, and hence the same sort of products. Now, of course, not all of us are either savvy enough or aware enough on a monthly basis to be able to consciously or actively make these deployments. Instead, if we can find an avenue so that, just like that fixed deposit sweep account, if this excess savings is swept into a certain investment product of your choice, which you have diligenced in the first place and have you already made an investment in the first place, those sweeps that occur on a monthly basis or a quarterly basis or whatever the period you choose, ensure that these savings are more optimally deployed into the funds of your choice, based on the asset allocation that your financial plan has come up with. So that was the motive behind launching this, rather than you being left in the lurch as to what should I do with this savings, which has now had, you're left with two problems. One is you've left those savings in a suboptimal product as a savings bank account or a liquid fund, and the second problem is, where do I deploy this? To address that, we launched this SIP. It's a systematic or more disciplined way of saving than trying to dollar cost average. A lot of people confuse this with saying, okay, I'm sitting on a lump sum amount of money. Now, I'm not sure where the markets are going to be. Therefore, instead of putting that lump sum in one shot, I will break that into a few tranches and do that. Our SIP is not meant for that. And SIP is meant for, you have inflows coming in, you allocate that automatically into those assets. Why it is not meant for addressing the issue of timing the market is the subject of our latest newsletter. I'm not sure how many of you managed to read that, but if you haven't read it, not to worry. This is exactly what Rakshit is going to talk about for the next half an hour, 45 minutes or so. We will also talk about developments in the portfolio. I'm happy to take questions as ever. So With that preamble, I'll hand over the stage to Rakshit, who will talk about why SIP is not necessarily a way to address the timing issue about investing into CCP or KCP. Over to you, Rakshit.
Thanks, Pramod, and a very good evening to everyone. Thanks for dialing in. Before I begin, given the context that Pramod has highlighted to SIP, there are effectively two options that an investor has when it comes to doing something with his or her monthly recurring cash flows, right? Based on these two options, the outcomes can be very divergent. So let's go through these two options, which is exactly, as Pramod mentioned, what we highlighted in our most recent newsletter. So we've defined here two investors who follow these two options. One investor we've called as Mr. Mortal _SIP, as in a person who chooses an SIP, and he doesn't have any skill set to time the market. And the second individual we've defined here is Mr. Market Timer, right? So what do Mr. Mortal and Mr. Market Timer really do? So both have a recurring monthly cash inflow on the first day of each month. Right, let's say both are earning a particular salary, whatever it could be, 5, 7, 10 lakh rupees a month or whatever, or lower number or higher than that. Out of that, let's assume that they both set aside the same amount of money as surplus saving, right, or surplus cash, which is free for investments. And let's just, for simplicity's sake, assume that both of them have got 5 lakhs per month for investment in Marcellus CCP. So the products are decided, their quantums are the same, and the frequency is also the same, which is first day of each month they receive this, right? Now, over the last 25, 26 months, ever since Marcellus has started managing money under the CCP PMS, let's assume that both of them, they deployed their cash flows using two different approaches. So the approach followed by Mr. Mortal is that he invests he invests his rupees 5 lakhs on a monthly basis through an SIP route, right? Which means that regardless of where the stock markets are or where the Marcellus's portfolio is, on the first of every month, 5 lakhs gets deducted from his bank account and goes into his Marcellus's CCP PMS account. Whereas Mr. Market, he follows an algorithm, right, which he revisits on the first of every month. So the algorithm says that you should invest if the market has fallen recently, and you should wait if the market has risen recently, right? So what is the definition we've used here for market fall? So let's say on the first of every month when cash inflow comes in, if Nifty 50 has delivered a negative return over the last 1 month, then Mr. Market Timer decides to allocate the 5 lakh rupees received in that month and any other accumulated funds that he had into Marcellus's CCP PMS. Whereas if the market has gone up over the last 30 days, right, then Mr. Market Timer decides to wait, keep the funds idle in his bank account, and he decides to revisit the algorithm on the first of the next month. So in effect, he's waiting for a crash before he deploys his top-ups. Top-ups are only coming from recurring cash inflows. They are not part of accumulated large surpluses already present in the bank accounts, right? So that's the algorithm. Now, the reason why, in fact, Mr. Market Timer's thought process we've decided to shape up like this is because of a few psychological constraints that most investors face, right? So the first constraint that people have is, for instance, if you consider the month of, say, November, markets as well as Marcellus's portfolio went up by around 10%. A very similar quantum in the month of December. When the portfolio goes up by say 5-10% over a month, right, then there is likely to be a psychological constraint against investing incremental funds if you have the discretion, or if you are willing to take the discretion to delay and wait for a market crash, right? Or the second apprehension that that many people can have is that, look, all of these stocks like say Pidilite, Asian Paints, Page Industries, Nestle, HDFC Bank, they are all trading close to their 52-week highs. They are all substantially higher on their PE multiples compared to the broader market's PE multiples. And hence, should I not wait for a little bit of a correction in their share prices? Or there could be a third reason, which is that without having any control on deployment timelines, going in for the same sort of boring stock portfolio month after month after month might become too boring to digest for an investor, and hence a little bit of excitement comes in from the sort of ability or willingness to time entry exits, even though you've decided to go for the same boring stocks month after month, right? So that's those are sort of 2 or 3 psychological rationales for why Mr. Market Timer thinks about timing his top-ups, despite having chosen the product that he wants to go for, right? So that's a broad construct, right? Not too dissimilar compared to I would say many of ours intuitive thinking. But let's just see the outcome that this gives to Mr. Mortal and Mr. Market Timer, right? So this chart shows you a timeline since 1st December 18, when Marcellus CCP PMS started, right? The one of the 2 lines which is going up in a steeper manner is the NAV for CCP PMS, right? And the second line, which has not moved much over the last couple of years, is Nifty 50, right? They both have started at 100 rupees as the base and progressed thereafter. What you can see is that the bubbles, they denote the timing of top up for Mr. Mortal and Mr. Market, right? So the lighter shade bubble is Mr. Mortal's investment via top up, which you can see happens with the same quantum. So size of the bubble is the quantum. The size of the bubble for every month is the same, and every bubble happens on a monthly basis, right? So that's the SIP, 5 lakhs deployed on the 1st of every month. That's what Mr. Mortal is doing. He makes an XIRR of around 37%, right? XIRR obviously is weighted by time and size of the portfolio of the top up. So his XIRR is 37%, whereas the darker shade bubble is Mr. Market Timer, where you can see that whenever the market keeps going up, Mr. Market Timer waits for a better time to invest. As a result, there would be periods of 1, 2, 3, 4 months where you don't see the darker bubble appear because Mr. Market Timer is not putting in his funds into Marcellus CCP. And after having waited, if let's say it's a 4-month long wait, then 5 lakhs multiplied by 4, he invests 20 lakhs at the end of that waiting period, and the size of the bubble correspondingly is bigger, right? So that's how you read this chart. Interestingly, Mr. Market Timer's investment XIRR is around 4 percentage points lower at around 33% versus 37 for Mr. Mortal, right? Despite the fact that Mr. Market Timer always invests after a market crash and always waits after a market rise, right? Now, why does this really happen, right? So why is there a massive difference between 37% and 33% on the 2 XIRRs? Is broadly because of 2 reasons, right? So let me try to annotate here. It's broadly because of 2 reasons. How can I? Okay, I can draw some shapes, right? So reason number one is Mr. Market Timer is left waiting when the market doesn't perform. So if you look at August 19 to Feb 20, right, which is this lull period, right, this lull period when Market Timer has not put in his investment, right. What's happening here is the market is not giving a negative monthly return, right, because since 1st of August, there is no negative monthly return. Mr. Market Timer waits for the crash. The crash does come later with a little bit of a lag, right? But in the meantime, CCP PMS's NAV goes up quite significantly, despite the fact that the market doesn't go up much, right? So the market return during this sort of August 19 to Feb 20 period is barely anything. It's less than 10%, I can see broadly. Whereas for CCP PMS, the return during the same time period is roughly more 25-30% or something like that, right? So you miss out on the opportunity to ride on a stronger NAV curve, despite the fact that you actually got the market call broadly right. Market didn't go much anywhere. You waited for a crash before you deployed, right? So that's one reason why the XIRR reflects the drag, right? Where Mr. Market Timer is left waiting when Marcellus CCP performs, but the market doesn't perform, right? The second type of example is how do I undo? Okay, yeah. So the second type of example is when Mr. Market Timer is left waiting when both market and Marcellus CCP go up, right? So here he is waiting for a crash. The crash doesn't come. Not only does Marcellus CCP go up, which happened even in reason one, even the market goes up, right? And this also happens quite frequently. So if you see this period, both these encircled periods, right, are time periods when Mr. Market Timer waited for a crash. The crash didn't happen. Both the market and the CCP NAV went up. Right now, at this point, it's actually quite interesting to note how this reason number 2 will play out, perhaps at the end of this month, the current month, January 2021. Yeah, because last time Mr. Market Timer invested his top up, if you see, was when CCP NAV was around 130 rupees, right? Because if you look at 1st October 20, right, CCP NAV was 120, 130, right, somewhere around that. In early Jan, it was at around 170. By the middle of Jan, somewhere around 180, right? So it has gone up by around 30-40% or thereabouts. Despite that rally, when the market crashes, right? Because market has crashed and we are down about 5-6% since the peak, which was achieved at the end of the first week of January. We are down by about 2.5-3% since 1st of Jan. This month, if there is a negative market movement, then Mr. Market Timer will get excited, right? And I'm sure if some of you are aligning with Mr. Market Timer's thinking, you must be getting very happy, excited about the fall, right? Because here comes the fall, I will get to invest at a lower level, right? But look at it like this, that Mr. Market Timer still would have lost the opportunity to compound over the last 3 months. Why? Because from 180, we are down to, let's say, 170 on the CCP NAV, right? Let's say this goes down to something like 160 by 31st of Jan. And then Market Timer invests, right? So he's investing with a 20% crash, but he's lost the opportunity. He's lost the opportunity of compounding from 130 to 160 at least, right? In effect, what I'm saying is, even though by waiting for a market crash, you might end up investing at a 1 month low point or a little lower than all-time high points, you miss more than you gain because you are left waiting in the compounding engine, which goes up more often than it comes down, right? Especially in the CCP stocks, right? So that's it. This is this is something worth bearing in mind. Whether it be for reason 1 or reason 2, the benefit of waiting for a crash is more than offset by the disadvantage of being left waiting when the compounding engine was on, right? This is something which is very important, because I realize, I'm sure when Pramod was giving the introductory part, I could see somebody asked a question, won't it make sense to wait for around a 40% fall, right? Now, interestingly, even when there was a 70% fall in the market during the 2008 crisis, the CCP types of companies, they fell by 25-30%. To begin with, the 30-40% fall is the probably 1 in a 100-year event type of a crash, or 1 in a 50-year event type of a crash. It's one of the sort of worst case scenarios possible, happens very infrequently, right? Because if you remember, even during the COVID crash, market fell by 30% from 1st Jan to 31st March. Our portfolio fell by 12.9% over the same period, right? So a 30-40% crash happens very infrequently. Even if it happens, right, it will happen after the compounding has gone up way above 30-40%, and hence even after the crash, you will be missing the bus in a way on the compounding engine. So look at it like this: if you consider this time period of the market, sorry, CCP NAV going up, right? Even after the crash of COVID came, the bottom of the crash was still a little higher than sort of July, August levels. So somebody who was waiting since July, August for a crash, he would have felt very good with the COVID crash, but still his entry point was not lower than July, August, right? That's one example, and this happens quite frequently. So let's go to some more instances. When you, okay, how do I stop annotating? 1 second. Right. So when you look at a longer time frame, right, and this slide shows you for Asian Paints over the last 10 years how the share price trajectory has gone about versus Nifty, right, Nifty 50, right? Because the previous slide, you can argue, was only a 2-year period, relatively short term. So this slide covers a 10-year trajectory. Obviously, over a 10-year period, I mean, Sensex Nifty appears like a straight horizontal line. So to make it look a little clearer, we have broken it down into 3 smaller parts, 4 plus 4 plus 3 over the last 11 years. So the charts, the 3 charts at the bottom half of the slide, let's just look at those. If you look at, let's say, in the first chart on the left, bottom of the slide, the June 12 to June 13 period, right? If you look at the June 12 to June 13 period, you can view my mouse. Sorry, June 12 to June 13 period. This period, you can see reason number 1 at play. Right? Reason number 1, which I explained in the previous slide, was there were no meaningful market corrections, but the market didn't go anywhere. To that extent, the call of waiting went all right during June 12 to June 13. However, the problem was Asian Paints' share price went up by several percentage points, right? So that's where a market timer misses the bus completely. If you look at it from, let's say, in the second chart, you look at Jan 17 to Jan 18, right? This period, Jan 17 to Jan 18, you see both the market and Asian Paints' share price went up quite meaningfully. And they went up without much of a market correction. So market timer was left waiting again. And this is sort of rule number 2 at play, or sort of reason number 2 at play. And when you combine these instances, there are several of them, right? March 14 to March 15, if you see here, again, market as well as Asian Paints go up materially. Waiting for a lower entry point is not so fruitful. Again, June 10 to November 10, if you see early here, right? Market as well as Asian Paints. So the frequency of left waiting, quote unquote, is much higher than the frequency of, wow, I've got a crash, now I'm going to invest with a lower entry point, right? And that's one of the reasons why net, it always helps going for a top up through monthly cash inflows in an SIP format, rather than holding on to the top ups and then waiting for a lower entry point, right? So that's those are some data points. Also, I'm sure some of you at this point might be sort of thinking that isn't it that Asian Paints' PE multiple over the last 10 years has gone up, and hence this chart might not get repeated in future if the PE multiple doesn't go up further like that, right? That's also an incorrect way to look at it, because even 10 years ago, in 2010, right, Asian Paints' PE multiple was twice that of Sensex Nifty. And even today, or even 5 years ago, Asian Paints' PE multiple has been twice that of Sensex Nifty's PE multiple, right? So it's not that the contribution of PE multiple has been disproportionately more to Asian Paints' share price return versus the broader market, right? That's not the case at all. And hence, I mean, you should expect the conclusions from these slides that we are discussing here to repeat time and again in future, right? So that's one way to understand this. There are a few more mistakes actually which the previous slides did not cover, and these are mistakes that Mr. Market Timer will certainly make once he has the discretion of timing, right? Once he's not chosen the SIP and he wants to go for the discretion of timing. The first incremental mistake he'll make is he'll not sit on cash for only the time periods that were shown in these charts. He'll sit on cash for much longer, right? Because as I said, I mean, we've now come down by whatever 5% in our NAV over the last couple of weeks. Maybe we go down by another 5%. It's highly likely that the market timer will not go all in with the entire surplus amount at the end of this month, right? He will say, well, look, budget is coming. God knows what will happen in the budget. Then now the NPAs will start coming out from the financial system from March onwards. God knows what will happen there. This event, that event, some state election, some general election, and other news around COVID or vaccine or a crude oil price or rupee depreciation or something else, right? These events will keep happening and a market timer will keep waiting, right? For instance, it was highly unlikely that anybody who could time the market, right, went in at the bottom in the month of March or went in during April, all guns blazing. Why? Because in the month of March and April, actually, there was no evidence of any improvement in the external fundamental factors, either related to the virus or related to the lockdowns or related to, let's say the situation of economies, broader economic impact of this, etc. Right? Nothing had started improving in the month of March or April. A market timer would have continued to wait by saying that this is worse than GFC, this is worse than World War II, this is something that the world has not seen in over 100 years, etc. And hence the wait is actually a lot longer than what we've used in our analysis. The second point, which is an incremental mistake which our charts haven't yet covered, is profit booking, right? If you are being given, if you are giving yourself a trigger, if you as an investor are giving yourself a trigger to decide on the timing, you will not just decide on your top-ups. You will also decide on the capital, right? You will try to book profits. You will try to redeem the entire investment with the hope that you will go in later again with the entire pot, and hence the XRR drag that we have shown in our previous slides, right? Remember, the XRR drag on this slide is on only the incremental monthly cash inflows which were not invested. What had already been invested is still benefiting from compounding for both types of investors. But in all likelihood, Mr. Market Timer will not let all his existing investments stay in if he's going to wait for a big market crash. He will actually redeem he will actually book profits, and he'll do a lot more than just wait on a couple of months of cash flows in the bank account, right? And why booking profit doesn't make sense, we explained in our previous webinar. Just to reiterate, this bell curve tells the story very nicely. The orange line is Marcellus CCP over a 12-month rolling period, and the rolls have been done on a weekly basis, as in 1st December 18 to 1st December 19, 8 December 18 to 8 December 19, so on and so forth. On a weekly basis, if you pick up 12-month investment time periods since Marcellus CCP inception, you would get the orange curve, which peaks at around 20%, has no negative data point, not even a single instance of 12-month negative return, and 80% of all data points are above 16-17% 12-month return, right? Which then makes it completely futile to book profits in a portfolio like this, right? Which, by the way, if you plotted the bell curve on Nifty, Sensex, or collection of sort of cyclical / mediocre quality plays, it won't look like this, right? This is only for highest quality, fundamentally oriented companies. So in summary, let's just conclude what we've understood from the analysis so far. Why does market timer lag behind Mr. Mortal, who does SIP, in XIRR outcome? First and foremost, left waiting variant number 1. When CCP performs, but market doesn't perform, market stays flat. Second, something that is happening now, right? Left waiting when both market and CCP go up. And even though market crash eventually happened, it didn't totally compensate for the rally that preceded during the left waiting period, right? The third point is using your discretions to actually book profits and not time only the top ups when it comes to waiting for a crash. And the fourth one is sitting on cash for much longer than what the analysis had showed previously, right? Combine all these four. If you let psychology take better control of your decision making, and this is all psychology, waiting for a crash, thinking that I know when the markets will crash because I can see XYZ external indicators, I can read the newspaper, I can figure out when the market will crash. That doesn't actually help in CCP types of portfolios because of these four reasons, right? Now, having said that, some disclaimers which Pramod had already mentioned, but let me repeat here. The SIP approach does not replace lump sum investment of capital, which has already got accumulated with an investor. SIP is only for recurring periodic inflows, right? This is not for lump sum investments. Lump sum investments, we continue to believe, should be done in a single shot in a portfolio like CCP, right? And the second point being, please don't mistaken us from this analysis. All the charts gave you the XIRRs of only the top-ups. Having said that, that doesn't mean that you can open a PMS account with only a 5 lakh top-up. So the example of 5 lakh applied only for top-ups, obviously after you have funded your account with minimum of 50 lakhs, right? So we are not indicating that if you choose SIP at Marcellus, you can fund your account with 5 lakhs first installment. No, if you choose it, even then you will have to go for 50 lakhs to begin with, and top-ups can be 5 lakhs, right? A minimum, etc. Or in SIP, it's actually a minimum of 2 lakhs on a monthly basis. So that's all there is to it. These are the performance charts. You would be aware of this. And Pramod, let's open the floor for Q&A.
Yeah, so there are quite a few questions around SIP. Again, worth reiterating what Rakshit reiterated. It's not about the lump sum that we are trying to replace with an SIP. If you are sitting on a lump sum amount of money, we've demonstrated that 2 out of 3 times you are better off deploying it in one go, as opposed to tranching it out over any period of time. Of course, there are times when that'll outperform, but there's plenty of financial research available where they show that the probability of investing in a lump sum beats beats a staggered investment. This is exclusive. SIP is meant for a situation where you have periodic cash inflows, such as monthly salaries or monthly dividends or monthly profits from your business, and instead of letting them lie idle in a savings account or so, you have a ready opportunity to deploy that in the same asset allocation, the same products that you've already diligenced and done. So at the cost of repeating ourselves, that's an important distinction we need to make. There's a couple of questions around sort of corollaries where they're saying that we have been advocating investing without timing, so why now advocating SIP? I don't think there's any difference in what we are saying. SIP again is a way we are saying that look, if you have monthly cash flows, don't wait for a better opportunity to invest. Let those cash flows get allocated to the products that you've diligenced rather than let them idle. So different questions, all hinting at the same thing. Just to clarify, we did introduce STP, right? STP was an option we provided to clients, which is different from SIP. The STP allows investors to deploy your first 50 lakhs itself in a staggered manner. And here again, we reiterated in the webinar where we introduced STP that this was not our preferred way. Our preferred way is, if you've got 50 lakhs to spare, why put 40 lakhs of those in a liquid fund, put all 50 lakhs in an underlying portfolio like CCP. Therefore, you are putting your money to work as quickly as possible. Let the money work for you rather than let them lie in a liquid fund. Having said that, the only reason we said you can justify investing through an STP mode is more behavioral in nature, where all of us operate in not necessarily in a rational way. Rationality suggests that you need to deploy your money as quickly as possible, but some of might not want to see any losses in the short run. And as Daniel Kahneman told us in his Nobel Prize winning work, that human beings operate on loss aversion. So if it means that we reduce our grief a little bit, even if we know that these losses are short term, so be it, and hence a staggered investment makes sense. So with that sort of long-winded answer to the same question, we want to make sure that you get the thinking behind the SIP right. I'll move to some of the other questions. Also around timing, particularly somebody's brought up Warren Buffett. Warren Buffett recommends keeping your powder dry so that when the corrections happen, you can make use of those opportunities. Now, there are two aspects to it. One is it's an asset allocation call, and I'm sure all of you are doing your asset allocations based on your financial plan, or you have wealth managers or financial advisors who are advising you on that asset allocation. You make the call on how much of your money should be in cash, how much should be in bonds, how much in gold, real estate, equities, and so on. Based on that asset allocation is where you are allocating to specific fund managers. So once you've given us the money, we presume that this is the money coming out of that allocation into equities. Now, if on top of that, if we end up sitting on cash, we are doing the job of your financial planner or an asset allocator. We're jumping into the territory of your wealth manager, which we wouldn't want to. We are portfolio managers, which involves stock selection, and portfolio construction, which involves portfolio sizing as well. That's the value we bring to the table. We will not want to confuse that by saying that we'll also do your asset allocation. The second way to look at it, why did Warren Buffett do it? I'll request Rakshit to bring about the same, P multiple slide, which requires Warren Buffett to actually do that, because the sort of investable universe he operates in doesn't allow him to, invest at any time and yet earn a reasonably strong return. Some of you might have seen this slide many times, but we can't emphasize more on how important it is to understand how unique our Indian market is. We're blessed with companies which we call as consistent compounders, but which have demonstrated that ability to compound their earnings irrespective of the starting point of the investment. Over to you, Rakshit.
Yeah, sure. So this is an equation which is non-debatable, right? Price is a product of price to earnings multiple and earnings at any point of time. And one of the two factors, which is the PE multiple, it does not compound. And the second factor, it can compound, provided you pick up a good quality company. The PE multiple largely oscillates, right? It doubles or halves, etc. Over across the cycle. Whereas the earnings can compound. Now, sticking specifically to the Warren Buffett point that is being made, you can have three types of scenarios of earnings, right? The A, B, and C here are different around earnings compounding only, right? So if you've got 0% earnings compounding versus 12% versus 25%, then what can the PE multiple do to your eventual outcome of the share price is what these three sets of equations are showing, right? Now, if I were to just use some rough numbers, in India, according to us, at least 70 to 80% of the entire listed universe belongs to category A, right? Category A is where more or less earnings don't compound much. I mean, maybe 0, maybe +3, maybe -3, but earnings don't compound much. There are lots of companies in this country where 2-3 years are good, and then there is a 5-6 years of lull, and they all belong to this sort of a category. Earnings engine is dead, right? For these companies, even timing won't help. So no Warren Buffett's advice or no Howard Marks's waiting is going to help much, because the PE multiple here will not bail you out, right? Whereas the B for Buffett, and we've taken specifically B for Buffett here as an example because that's what he does, and he's done it very successfully, is a category where your earnings compounding will happen at a rate of say 10, 12, 13, 15%. And in order to compound at anything north of 20, you will need the support of PE multiple expansion, right? Without PE multiple expansion, there is no possibility of doing a buy and hold and still compound at above 20, right? So in your buy and hold, you need PE multiple expansion. That's what Warren Buffett does. Why does he do that? Because category C, which makes the PE multiple redundant for a 20% plus compounding outcome, category C of 25% earnings compounding is not available to investors such as a Warren Buffett, or in markets such as, let's say, the US, UK, Europe, Japan, etc. You do not get a Walmart or a Coca-Cola or a Goldman Sachs to compound earnings at 25% decade after decade, not year after year, decade after decade, over longer periods of time. You do not get those sorts of candidates in the foreign world. Why don't you get it? Well, efficient markets have always suggested that if a company is delivering return on capital million miles above cost of capital and also delivering growth of capital employed alongside, that's a very attractive proposition for competition. And competition always tries to narrow the gap of return on capital and cost of capital down to as low as possible for such an incumbent dominant player, right? That's what has happened to a Coca-Cola. That's what has happened to a Walmart. That's what has happened to various other companies, right? A Washington Post that Warren Buffett picked up when it was struggling has not delivered a 25% earnings compounding decade after decade. The Seas Candy has not done so, right? So if you are picking up a portfolio of companies where the earnings compounding engine guns out 10, 12, 15%, then you need PE multiple expansion. You need to pick up Washington Post at the rock bottom. You need to pick up a Goldman Sachs in 2008. You need to pick up an Apple before the whole world jumps up and down on an Apple, right? You have to do that. If you don't do it, then earnings itself will not bail you out from the challenge of going above 20%. Whereas if you pick up an Asian Paints, an HDFC Bank, a Nestle, a Pidilite, so on and so forth, the earnings itself is good enough for you to get a more than 20% outcome on the first column of this table without PE multiple support. In fact, PE multiple compression is also all right if your earnings is compounding at a rate higher than 20, right? So that's something worth bearing in mind, and that's why we've called B for Buffett here.
Enough. So, the valuation point is explained from the multiple standpoint, where we're making the multiple irrelevant. But I think there are a few related questions around, absolute valuations of sort, where people are saying, so let's say, see what happened to Abbott. Abbott hasn't rallied because of the high valuation. So that goes to show that valuation should be a consideration. We totally agree. I think one thing we'd like to clarify is ours is not a buy at any price strategy, although it might look like that. And having said that, I think, Rakshit, it might be worth spending some time about how we look at valuations. Bottom line is, unlike like every other value investor, we buy stocks at a price which is significantly lower than our assessment of the intrinsic value of the company. The only difference is we don't arrive at the intrinsic value using PE multiples because they don't do justice for companies which have very long growth runways. How do we incorporate those long growth runways? The obvious way is DCF, but I'll request Rakshit to throw some light around it. But the specific question around Abbott, I think is very easy to answer. Abbott also we continue to hold because we believe that the current price is significantly below our assessment of the intrinsic value. The fact that it's not run up is a fairly simple thing. The last 3 months, the rally has been driven largely by FI inflows, particularly the last 3 months, almost close to $30 billion. Abbott is an FI restricted stock. None of these $30 billion can go into Abbott. So it's if you look at most FI restricted stocks, that you will see that in, sort of underperformance to the rest of the market come out. But I'll request Rakshit to talk about our valuation framework a little bit, so that you get a sense of what we're doing when it comes to making a call on the valuation before we actually buy the stock.
Sure. So let me quantify it for you to give you a broad sense. And we published a newsletter for those of you who are interested in this subject in a deeper manner. Please read our 1st January 2020 newsletter, which came exactly a year ago, which came out exactly a year ago. So let me quantify what that newsletter had talked about. So if you've got a stock where you believe that the earnings can compound at, let's say, whatever, 20% or 15 or 25, right? Whatever, 20 to 25%. Let's assume you've got a high quality compounder. But if you are unsure of expecting that rate of compounding beyond, let's say, 3 to 5 years, and then you want to factor in the probability of disruption, macro volatility, the firm imploding, becoming complacent, fatigue kicking in, whatever, lethargy, I can go on and on, different factors which can bring the compounding engine to a halt, right? If you want to build in the risk of these factors slowing down the compounding engine within the next 3 to 5 years, then despite expecting, say, 20-25% earnings growth over the next 3 years, there is no way the fair value of the stock can go above 20, 30, 35 times PE multiple. The fair value of the stock will be somewhere around 20 to 30 times PE. If you're buying that stock at 50 or 60, then you are making a big mistake, right? Vis-a-vis your conviction on fundamentals longevity, right? Now, take a second scenario. If you then say that, look, I believe that the current competitive advantage of this portfolio, of this stock, is difficult for competition to disrupt or replicate in a short period of time. And hence, it's not 3 to 5 years, but it's more like 8 to 10 years that I want to build in before a disruption kicks in my expectation. But I don't want to go beyond, say, 7, 8, 9, 10 years in my expectation, because look, the current CEO will retire after 5, 7, 10 years. the current promoters will have a succession planning event coming up. Over the next 5 to 10 years, I can see that there are no foreseeable disruptions, but thereafter, God knows what disruption will come in, so on and so forth. If you extend the time horizon from 3 to 5 years to, let's say, 7, 8, 9 years, right? Then the fair value of that company suddenly jumps up from 20, 30 times in the previous scenario that I gave you to say around 75, 80, 90, 100 times in the PE multiple, right? On an absolute valuation basis. If you then go ahead and say that, look, I actually can foresee how this company has already started the journey of radically disrupting itself so that no competition can actually come in with a disruptive approach even 5, 7, 8 years down the line. And I can see that it has gone through 5 instances of succession planning in the past, 10 instances of capital allocation decisions in the past, and hence I'm willing to bet on a greater longevity than just say 7, 8 years. Then the valuation, absolute valuation, goes up further, right? So it's on that metric that you have to make the call. Now, you all can very well say that, look, I think we are getting into an Alice in Wonderland type of a scenario if we are going beyond 3 years, because who knows what's going to happen beyond 3 years. If you go like that, then there is no choice to be made between a good company and a bad company, because for all companies, you will have the same longevity. And wherever you see, let's say a 15% earnings growth, don't buy it. 20% earnings growth, buy it. Eventual outcome, God knows what will happen. I mean, it will make the whole investment exercise very complex. You will not get any success at it, right? There will not be any difference in your mind between a good quality stock and a bad quality stock, because think about it, for 5 years, a Yes Bank compounded at the same rate as HDFC Bank, actually higher rate than HDFC Bank, right? Between 2010 and 2018, if you look at Yes Bank, it would have compounded at a much faster rate than HDFC Bank, Kotak, etc. But if you are aware of the accounting, dodgy accounting aspects of Yes Bank, right, which some of our colleagues at Marcellus have already demonstrated how you can be made aware of these things, then you would say that, look, I don't care at what rate the earnings are compounding. I want to associate a very short longevity to this stock. At 5 times PE multiple as well, this is expensive for me, even if it compounds at 50% YOY, right? Whereas if you are getting the best quality of earnings, and quality doesn't necessarily just mean only accounting quality, it's also various other aspects, then you make a different call, even though earnings growth might be lower than Yes Bank. The absolute valuation could be much higher. Absolute fair value could be much higher, right? And just to elaborate that point via this slide, if you look at the table on the right hand side, over FY 15 to 20, right, our portfolio's fundamentals, profits have gone up at a rate of 19% CAGR, right, over FY 15 to 20. What has happened between FY 20 and the end of FY 21, which we are now approaching, right? If you look at the next 3 years, so let's say you are looking at FY 20 to 25 expectation that we have in our minds, right? Without COVID, if we had, let's say, 20%, let's take a number to give you an example. If without COVID, we expected 20% earnings compounding, then thanks to COVID, because of the market share gains, the earnings compounding is expected to be a few notches higher than that. So in fact, the quantum of earnings, the quantum of cash flows that we have to factor in our minds today is higher. And 12 months have also passed by, right? So factoring in, I mean, for those of you who are aware of this lingo, it's called roll over your DCF or whatever you want to call it. As you get closer to those cash flows, which are at a higher rate than previously estimated, right? There's actually more value to be had. Now, what you might then say is, well, if I look at the trailing 12-month PE, it's 100 times, 110 times, 130 times for all your portfolio companies. So are you telling me that even now they are not overvalued? The last 12 months are not representative of a normal time period, right? In the last 12 months, for at least 3 to 4 months, the earnings engine was shut. Not just compounding at a slow rate, it was shut because of the lockdown. Right? Month of April, May, there was no sale, no revenue, no nothing for bulk of our stocks in the portfolio. And hence looking at the last 12 months and then saying that, well, look, P multiple has gone up is like saying in the month of, after the month of demonetization, you come out and say that, that look at the last 12 months, it's very bad, or similar such events in the past, you can do this. If there is a temporary increase or decrease in earnings, the denominator, the P multiple will artificially look high or low. You don't have to get excited if the P multiple overnight goes to half because earnings doubled, right? Or if there was a corporate tax rate cut, earnings doubled, P multiple halved, you don't have to say that now the share price will double overnight, right? And at the same time, if the P multiple doubles because the earnings halved, you don't have to get worried that now the share price will half overnight, right? It doesn't work like that. So bear in mind the exceptional period of the last 12 months when you compute PE multiple on trailing earnings. If it is not norm, then you should not look at that.
Great. Then, you know, one of the questions around the relative underperformance to the Nifty since 1st April. If you can just elaborate using the data for the 3 months as well.
Yeah. So if you look at this chart, in the last 3 months, I mean, a 3-month time period is not here in this chart. During the 3 months ending 31st December, our portfolio outperformed Nifty by, I think, some 5-6 percentage points, if memory serves me right. If you look at the 3-month period of, let's say, 1st Jan to 31st March, our portfolio outperformed the Nifty 50 by around 17-18%. Right? As I said previously, Nifty fell by 30% and our portfolio fell by 12-13%. Right? If you look at the time period between these two, as in 1st April to 30th September, during those 6 months, our portfolio underperformed the Nifty 50 by, I think, some 15-20%. Right, if not more. So should we be worried about the time period of 6 months where our portfolio underperformed? Not at all. Reasons being, first of all, that underperformance was because of non-fundamental factors, as in it was not that the fundamentals of our portfolio companies were underperforming vis-a-vis fundamentals of Nifty or Sensex. Profits of our companies were not growing at a slower pace than profits of Nifty or Sensex. As long as that underperformance is not happening, we are not worried about a 6-month underperformance at a share price level. Second reason, obviously there are stocks like, say, a Hindalco or Reliance Industries, which went up by more than 100, 200, 300% over those 6 months. And we don't hold those companies for a variety of reasons. They don't fit into our philosophy, which we've explained previously, and hence we are happy to go through underperformance. If stocks that we don't want to hold, they do better than the market, despite the fact that on an absolute basis, the stocks that we continue to hold deliver a performance similar to what we expect, both on the fundamentals as well as on the share price. So as long as that happens, we are happy to underperform over a 6-month period. The third reason is an optical measure. Right. So if you look at FYTD, the second bar from the left on this chart in front of you, that time period starts on 1st April, which was the bottom of, more or less the bottom of the market crash. Right. Now, if an asset class falls, if the drawdown in the asset class is significantly more than, let's say, our portfolio, right, then the recovery from there can optically be sharper when it actually is not. So let me take an extrapolated example to explain this. So an HDFC Bank versus IndusInd over the last 12 months is a very interesting comparison, right? During the first 3 months of calendar year 20, HDFC Bank fell by, I think 30, 40, 50% or something like that. And IndusInd Bank fell by 70, 80, 90%, I think 80 or 90% during those 3 months. Right? Now, if a 100 rupee IndusInd Bank becomes 10 rupees and an HDFC Bank from 100 goes down to 50, then an HDFC Bank recovering to its previous levels will mean 100% return, right? From 50 rupees, you're going to 100, right? That's the full recovery to pre-crash levels. That's a 100% return. Whereas in the same time period, if an IndusInd Bank delivers a 300% return, it is still up from 10 rupees to 30. It is 70% below its pre-crash levels, right? So that's a mathematics which you should bear in mind. If the drawdown in an IndusInd Bank is 90%, then no matter how much outperformance is there in the recovery from the bottom, it hasn't recovered still, right? If you see what I mean, right? Similarly, if Sensex Nifty fell by 40% from their peaks or 30% from 1st Jan, we fell by 12% from 1st Jan, right? We going up by 53%, 53.5, and Nifty Sensex going up by 63.8 should not worry you, right? Because this is optical. Whereas if you look at a 12-month window on a 12-month basis, 33.8 versus 16.1 sort of gives you a little more like for like. Since inception gives you a lot more like for like, right? Shorter time periods will always have these optical effects. Don't get too bogged down by that.
Right. So again, an obvious question around financials and the risk of NPAs, particularly retail NPAs. How are we comfortable about the financials exposure in our portfolio?
Right. So very good question. And my colleague Tej, who runs the Kings of Capital Fund, he did a recent newsletter explaining this precise point. What he explained, and he did a webinar as well recently. What he explained in that newsletter was that if you look at the lenders in our portfolios, whether it be KCP lenders or CCP lenders, if you look at the lenders in our portfolios, they have got a capital adequacy ratio of more than 20% on average, right? Across all the sort of 8 lenders in KCP and 3 lenders in CCP. Capital adequacy ratio for all these is around 20-22%, despite the fact that they've provided for around 10 to 15% of the moratorium book already, right? So their capital adequacy is much higher than regulatory requirements, which means they have surplus capital which can be used to accelerate loan book growth, despite the fact that they've already taken a hit via provisions on 10 to 15% of the moratorium book. Compare this to the rest of the industry. So let's say you compare this to the PSU banks. For the PSU banks, which control 70% of the market share of credit in the country today, the capital adequacy ratios are 10, 11, 12, 13%. Very close to the regulatory minimum requirement. At times, in some cases, little below minimum regulatory cap requirement. Whereas their provisions on the moratorium book are only 1 or 2% of the moratorium book, right? So despite significantly lower provisioning, the capital adequacy ratio is not a million miles above regulatory capital requirements. What that means is when the 6-month window after 31st August of moratorium closure ends, right? The 6-month window will end sometime in, let's say, end Feb or whatever. And when you then start seeing the real NPAs of COVID from both the moratorium book and otherwise, right? You will see the need to provide for those NPAs being much higher in, let's say, the PSU banks. And once they provide for that, they will probably need to raise capital to just survive. And they will not have surplus capital to accelerate loan book growth. Whereas when you look at our portfolio companies as lenders, the need to provide incrementally is negligible, probably non-existent, and provisions will more than provide for whatever NPAs come in. And their surplus capital available above regulatory requirements is significant enough to accelerate loan book growth in areas where they see disciplined lending possibilities, right? And remember, this ability to figure out a higher quality borrower was not there till say August, September, and hence you have not yet seen the benefits of the dynamic that I just mentioned through a loan book growth expansion, earnings growth expansion till the 30th September results, because obviously there was no data available much on the real impact of COVID on borrowers' credit profile. Given the moratorium was still ongoing, there was not much data available from the credit bureaus because they were not, they did not have enough feet on street to get the credit data engines going, etc. And hence, as things have now started to normalize from December quarter onwards, then March quarter and thereafter, you will see the massive benefits of surviving with a healthy balance sheet after a massive crisis like this, right? Not only will loan book growth accelerate, net interest margins will expand. Evidence is already there. Cost of funding has gone lower, right? And competitive intensity has dropped down to a level where the overall quality of this growth will be far better than what it would have been without COVID being there, right? And hence we are actually quite optimistic about the lending exposure that we have, lenders exposure that we have in all of our portfolios.
Great. Another stock-specific question around Asian Paints, where somebody's highlighted the promoters' pledge rising. Would that be a cause for worry for us?
No, it's not a cause for worry. So over the last 5 or 6 years, these pledges have been going a little down to begin with. It's one family, which is the Dani family, that has got these pledges. They were made in 2012-13, if you go back in time. All these pledges are 8 to 10 years old, right? Since then, actually, they've reduced, as I said. And the pledges were made to fund ventures which were set up by the Dani promoter family outside the purview of the listed entity, which is Asian Paints. And hence they've got nothing to do with weakening balance sheet of the promoters. They've got nothing to do with COVID. They've got nothing to do with any friction or challenges that we believe might be the reason behind these pledges of one promoter family out of the 3. Nothing of that sorts. These are 8 to 10 year old pledges. They've been coming down and they've existed for reasons not linked to fundamentals of the promoters' personal balance sheets.
Yeah, there's another report when in IT stocks, and they give a natural hedge over domestic economy versus exports.
So IT stocks, the challenges, I mean, there are a couple of them in our coverage universe. In some of our advisory portfolios, we have TCS and Inflow Edge. We like them. They're high quality companies. But if we were to select 10 to 15 stocks which compound at, say, earnings growth of 18 to 20% or higher, right? Then on that rate of compounding, IT stocks don't make the cut, especially say a TCS. We don't expect 18, 20% or higher earnings growth from a TCS. And hence, if we were to build a longer portfolio for someone, which is what we do in one of the advisory portfolios that we have, TCS is part of it. But if we have to restrict the number of stocks to say 13 currently or 10 to 15 as part of this philosophy, then TCS is not amongst the top 15 rate of compounders, run rate of compounders, and hence not part of this. In terms of the hedge, I mean, the fundamentals of our portfolio companies, once they are very low volatility, which we have showed over the last 1, 3, 5 years, 10 years, for the next 2, 3 years, etc. And whether it be GST, demonetization, black swan events like COVID, the fundamentals of our portfolio companies do not undergo a massive volatility, and hence we don't need to hedge necessarily anything like the question mentioned about hedging of against exports through IT.
Okay, and another question is around short-term price movement. Somebody is asked why Abbott hasn't performed in the last few months, why Dr. Lal hasn't performed. In fact, somebody is asked why Asian Paints hasn't performed in the last few days. Is it because of Indigo Paints IPO? I mean, to be honest, folks, we don't really know. At the moment we start putting reasons to these short-term share price movements, we are justifying these short-term share price movements. At the expense of repeating, short-term share price movements are nothing less than random, right? So they are dictated by liquidity. They're dictated by demand, supply of shares in the marketplace, which can vary based on several factors, none of which we have any competence to predict or understand. And hence our intention is to focus only on the long term, because as Rakshit has proven in that beautiful table of earnings growth and share price, you might want to beam that table again, Rakshit. There is significant difference in earnings growth and share price performance on a 1 year period, as that table shows. But how beautifully the table shows that as soon as you move to a 3 year and 5 year horizon, how beautifully share price performances converge to earnings growth. Right? So if we are reiterating time and again, do not give us any money that you need in the next 3 years. We don't have a lock-in, we don't have any exit loads, but that doesn't mean that we're open for investors to coming in and going out anytime. If you come to us with a 3 year horizon, you're more or less likely to get your returns commensurate to the earnings growth. Right? It's very unlikely that the portfolio will deliver an earnings growth of 20% and you will be left with a return of 5% or 10%, irrespective of the entry point. At the same time, it's very unlikely that a portfolio delivering a 20% earnings growth will give you a 100% compounded return over the next 3 to 5 years. Now, there again, there is a more nuanced, specific question worth answering, as somebody has clearly picked up. The 19% growth is slightly skewed, right? So we have one stock which is given us 42% growth, but there are a couple of them at 10, 11, 12% growth. Therefore, how do we see, now one, how do we explain some of these companies having delivered these sort of 10, 11, 12% growth over the last 3 to 5 years? Although the portfolio level earnings growth is in line with what we are aiming for. And therefore, what should we think of in terms of the earnings growth going forward, let's say over the next 3 to 5 years? And I mean, I guess it's easier, suffice to say that there will be skew in the portfolio companies. Not every company will deliver a 19% growth over the next 3 to 5 years as well. But any color on that, Rakshit, for our clients to understand?
Sure. So let's take some extreme examples, right? Page Industries has been in our portfolio. Last 2 years, earnings have not gone anywhere. On the negative side, let's take some more extreme examples rather than the 11, 12, 13% here, right? Thanks to COVID, FY21 is probably not going to be a growth year for many portfolio companies on earnings. So when you look at, let's say, if you were to do the same table 1 year later, the 3 year period will give you a very wide skew, right? There will be some companies like, say, Abbott, Nestle, where FY20 to 22 2-year CAGR will still be healthy, whereas there will be others where for an Asian Paints or some of the others, Relaxo, etc., it will probably not be so healthy because of 1 year being relatively weak. Now, what are the reasons? There are different reasons. What applied to Page is different from what applies to FY21. In FY21, obviously, the skew is because the event affects certain stocks more. The event of COVID, it affects certain stocks more than the others. And hence, earnings growth over a 12-month period is divergent for certain types of companies in the portfolio versus others. Obviously, it normalizes as you go to 3 years and 5 year time periods. The longer the time period, the more normalization. Hence, the narrowest band that you see is in the 15 to 20 year period. Whereas if you look at Page Industries, right, it was a company specific challenge. It was not so much of an external event challenge. Page Industries had, to a certain extent, company specific issues, and to a certain extent, GST issues, which affected only the textile industry players so brutally, didn't affect some of the other companies that we have in our portfolio. So those are some of the other reasons. And then there will also be companies such as, say, the lenders, where the underlying industry growth is much higher than the industry growth of home building materials, of FMCG, of various other stocks, right? So on and so forth. So these events keep happening. If I were to pick up specific examples of certain companies, when you're considering FY 15 to 20, one of the worst performances happens from Nestle, where FY 16 was affected because of the Maggi fiasco so badly that market share of Maggi is still not back to the levels where it used to be pre-fiasco, right? So hence it shaved off from a 5-year CAGR to 3-4 percentage points from Nestle's overall earnings growth. When you look at, say, something like an Asian Paints, right? They reported, they reported volume growth, which was always in double digit for the last 3, 4, 5 years, but they undertook significant price cuts because crude oil prices fell, right? And hence their revenue growth was adversely affected. So different reasons apply to different stocks at different points of time. If there was a possibility to build a portfolio without a skew, then actually we would have had a 5-stock portfolio instead of a 13-stock portfolio. The reason why we have a 10 to 15 stock list of portfolio is because at any point of time, 1, 2, 3, 4 such stocks will be undergoing a relatively moderate period of earnings growth. And these stocks will then return. So for instance, if you look at the paint industry, FY10 to FY13 3-year period was the highest for Asian Paints Berger compared to even an HDFC Bank or even, say, some of these Nestle and Pidilite and a few other companies, right? Asian Paints and Berger during those 3 years were delivering a significant growth in earnings because of a massive tailwind which they had from weakness of competitors, in particular thanks to crude oil price doing what it was doing and a massive jump in some construction activity in real estate, which contributes to 15-20% of the demand for these companies, etc. So different factors, they are at play at different points of time. But that's why we are building a portfolio. Pramod?
I think we have covered. Hi, can you hear me?
Yes, I can hear you now. It was breaking a little, but I can hear you now.
Yeah, sorry about the bandwidth. I was saying that we've covered most of the questions. Housekeeping questions, trust us, missed out anything, please forgive us and just give us a heads up on client support at marcellus.in. We'll make sure that somebody gets in touch with you and answers your query. But, it's been a pleasure, like always, very relevant question. We enjoyed answering your questions as much. Hopefully, you found the webinar useful. So thanks, Rakshit, and thanks for all. Goodbye.
Thank you. Thanks, everyone.